Tell me you live in Canada without telling me you live in Canada. Taxes, taxes, taxes. Yeah, I know we pay a lot of taxes in Canada, right? And that's just why I'm making this video, just to share some of the strategies that I use to keep more money in my pocket for myself. And of course, these strategies are very legitimate strategies. We don't do shady stuff around here. Hello. Yeah, but before I get into it, I just wanted to distinguish between three concepts. So tax deductible, tax deferred, and tax exempt. Let's get right into it. Okay, so the first one, tax deductible. So a tax deductible registered account is a type of account where the contributions that you do make into that account are subtracted from your total taxable income when calculating your taxes. So what do I mean by this? So say for example you earn an annual gross income of say $60,000, and you open any of the accounts that fall into the tax deductible category. So for example, you have the RRSP, the registered retirement savings account, and the FHSA. Those are two accounts that fall under the tax deductible category. So back to the example, you earn $60,000 and you open an RRSP account where you make a contribution of say $5,000. So at the end of the day, when you're calculating how much taxes you would pay, it would be the $5,000 deducted from the $60,000 you earn. So you will be taxed on $55,000 as opposed to being taxed on $60,000. So you see how you can keep more money in your pocket compared to a person who did not, or does not have an RRSP account. That person will be taxed on the full $60,000 earned, but you who has an RRSP account and has contributed $5,000 will be taxed only on $55,000. And so some of the accounts, like I mentioned, that are part of the tax deductible category are the RRSP, and for RRSP accounts, of course, for all of these accounts, there are certain rules that you have to abide by. So for RRSP accounts, there's a contribution limit. So the contribution limit for this one is 18% of your previous year's earnings up to a maximum of $32,000, right? So you can only contribute up to $32,000 or 18% of your previous year's earnings. Okay, and then the other one that falls under this category is the first home savings account, which is the FHSA. And for this one, you have a contribution room, an annual contribution room of $8,000 annually, up to a lifetime maximum of $40,000, meaning that you can only contribute $40,000 into this account for your entire lifetime. But for every year, you have a maximum contribution limit of $8,000, right? So that's it for tax deductible accounts. Okay, so for tax deferred accounts, these are accounts that sort of postpone the payment of taxes on the earnings made on these accounts to a future date. So let's rewind a little bit, right? Okay, so tax deferred accounts. One category of registered accounts that fall under tax deferred is also the registered retirement savings plan, RRSP. Remember we mentioned that the RRSP accounts are also tax deductible. So they are tax deductible and they are also tax deferred. So back to the example, imagine we open an RRSP account and we contribute $5,000 into it, or $10,000 into it, and then because I also mentioned that these registered accounts are investment vehicles, so you contribute $10,000 into it and you use it to invest in stocks or GICs or whatever investment you make, and that $10,000 grows to $15,000, meaning you've earned $5,000 on that account. The $5,000 that you have earned will not be taxed while the money still stays in your account. It's only going to be taxed at a future date when withdrawals from that account is made. And again, because it's a retirement account, then it's likely that you're only going to withdraw from the account when you retire. And at the point of you retiring in 30-40 years time, you're going to likely fall into a lower tax bracket than your present day tax bracket, right? So whatever tax you're going to be charged is going to be based on a lower figure than what you would have been taxed today if you were going to be taxed present day. And so that also is a way to keep more money in your pocket. I hope that did not confuse you. Okay, so for the third category, which is tax-free or tax-exempt registered accounts, these are accounts that are basically, just like the name suggests, they are completely tax-free either today or in the future, meaning that you can make contributions into those accounts and withdraw from those accounts as well without being taxed at all on whatever earnings you make on those accounts. So accounts like your tax-free savings account TFSA or your registered education savings plan RRSP, those are some categories of registered accounts that fall under the tax-free or tax-exempt account types. So now that we've talked about just cleared the air about these three different concepts, in my next post I'll be sharing some of the tips that I do or strategies that I do utilize to keep more money in my pocket for myself.